Have you ever considered investing in a mutual fund? There are many mutual funds that can help you diversify your portfolio, participate in the financial markets, and start investing. Mutual funds come in various types, each with its own investment objective and strategy. Some common types include equity funds. These primarily invest in stocks or equity securities. They can focus on specific sectors, market capitalizations, or geographic regions. Fixed income funds primarily invest in bonds or debt securities. They can focus on government bonds, corporate bonds, municipal bonds, or a combination of these. Balanced funds, also known as asset allocation or hybrid funds, invest in a mix of stocks and bonds to achieve a balance between growth and income. Index funds aim to replicate the performance of a specific market index, such as the S&P 500. These funds offer broad market exposure and seek to match the index's returns rather than outperform them. Specialty funds invest in specific sectors or industries, such as technology, healthcare, real estate, or energy. These funds allow investors to focus on areas of interest or capitalize on market trends. A mutual fund is a pooled investment vehicle that collects money from multiple investors and uses it to buy a diversified portfolio of securities, such as stocks, bonds, or a combination of both. These funds are managed by professional investment companies or fund managers. Fund managers are responsible for researching and selecting securities that align with the fund's investment objective. Mutual funds provide investors with instant diversification. Funds can spread their investments across a wide range of securities, reducing the impact of individual stock or bond performance on the overall portfolio. Diversification helps manage risk and may lead to more stable returns over time. You will not see the price of a mutual fund changing in real time. You will not be able to day trade a mutual fund. The net asset value of underlying holdings is calculated after markets close. Mutual funds charge fees and expenses to cover operating costs, management fees, administrative fees, and other related expenses. These costs are reflected in the fund's expense ratio, which represents the percentage of the fund's assets that go toward fees. When comparing funds, it's essential to consider expense ratios and understand how they can impact overall returns. Mutual funds often have several different share classes. The most common share classes for a retail investor to consider are A shares and C shares. C shares will often have a contingent deferred sales charge, CDSC, fee if you hold for less than a year. A shares will usually have an upfront fee associated with them but lower expense ratios, making them attractive for long-term investors. While mutual funds offer diversification and professional management, it's crucial to understand that they come with risks. The value of mutual fund investments can fluctuate based on market conditions, and there is no guarantee of returns. Investors should carefully review the fund's prospectus and consider their risk tolerance before investing. Consider factors such as the fund's investment objective, historical performance, expense ratios, asset allocation, and the experience and track record of the fund manager. Mutual funds are usually active investments where a manager is attempting to beat an index or to match the index with less volatility, whereas ETFs are passive, have no management, and are expected to track an index. Unlike mutual funds, ETFs value moves with the underlying holdings and can be day traded as prices move during the trading day. The ETF then rebalances at the end of the day to stay in line with the index. A mutual fund will only rebalance when a manager buys or sells. As a result, a mutual fund may have embedded gains or losses that can be passed to you, the investor, when the manager sells, even if you did not participate in those gains or losses. To summarize, mutual funds provide individuals with a convenient and professionally managed investment vehicle to participate in the financial markets. With their diversification benefits, professional management, and variety of investment options, mutual funds offer investors the opportunity to grow their wealth and achieve their financial goals. However, it's essential to conduct thorough research, understand the risks and fees involved, and align your investment choices with your financial objectives. By doing so, you can make informed decisions and potentially benefit from the long-term growth potential of mutual funds. Thanks for watching. If you are working towards retiring early, gaining financial independence, or looking to educate yourself on all things financial and found this video valuable, please consider subscribing. Liking and subscribing does mean a lot and is an indicator of how well the channel is able to help people like you that are watching this. Thanks again, and let's keep saving until the next video.